Good morning, everyone. We're going to go ahead and get started. I'm Stephen Phelps. I'm here with Avalara and our account representatives, Max and Jen. Today, Avalara will be discussing economic nexus and the future of sales tax. Please note the webinar is listen only. If you have any questions, please use the chat option or wait until the end of the question and A portion for the webinar. With that being said, I will pass the mic on to George to begin the presentation.
Thanks, Stephen. I appreciate it. And I'd like to thank you and Acumen for allowing me to speak to your clients. Today, I'll be talking about a new Supreme Court case that just passed last year that's really affecting the landscape of sales tax and how companies are now having new liabilities when it comes to that. So I'll just take about 25 to 30 minutes or so, nothing too crazy. I know we're slated for an hour. But I think everyone would go a little nuts if I talked about sales tax for that long. So what I'll do is just do a quick intro myself, talk about South Dakota versus Wayfarer ruling, economic nexus, what should you do, automating sales tax compliance, and any questions and answers you may have at the end. So just quickly about me, I've been with Avalara about 2.5 years. I'm not a sales rep. And that's important, the fact that I'm not trying to sell you anything. I'm literally just trying to educate you. My job is just to maintain the relationship between Avalara and Acumen. So if you have any sales specific type of questions at the end, I'll try my best to answer it, but I could also steer you to a sales rep. So in terms of just this being a knowledge-based agenda as to what you have and maybe some solutions that we may offer at the end. So South Dakota versus Wayfarer, what it was really about, before getting into that, you really have to look at the Quill Corp versus North Dakota Supreme Court ruling. Now, that was a Supreme Court ruling in 1992. The Quill Corp was a company that sold to the residents of North Dakota. They weren't charging sales tax. Well, North Dakota told them, well, you have to charge sales tax to our residents. And Quill Corp said, you know what? We're not going to collect sales tax because we don't have a physical presence. Now, I'm sure everyone knows Nexus, or if you don't, Nexus is just the obligation to collect sales tax within a certain location. And this set the precedent really of sales tax and being charged to where you have to have a physical presence that we all know. However, it changed last year with the Wayfarer versus South Dakota case. So this time, instead of the Supreme Court ruling in favor of the Quill Corp saying that you need a physical presence to collect sales tax, this time the Supreme Court ruled against Wayfarer and ruled in favor of South Dakota. And basically what it said is that no, you don't necessarily need physical presence anymore to charge sales tax. Now, the case was exactly the same. It was virtually a mirror image. Even the Wayfarer versus South Dakota ruling, Wayfarer argued, just I'd like to reference previous precedents of the Quill Corp versus North Dakota. There's one main difference that's changed from 1992 to 2018 when it happened. And that was the internet. The internet has literally changed the landscape of exactly what's going to be charged in terms of sales tax. And you have online retailers having an unfair advantage to brick and mortar businesses anywhere between 8 and 12%. So because of that, the Supreme Court felt that it was an unfair advantage. And that's why they decided to change the law. So remote sellers who are registered within the state who meet threshold requirements are now, even if you don't live there, if you have sales in excess of $100,000 or 200 transactions, you now have to collect and remit sales tax. And the most important impact of this is that physical presence has been overturned. Now, you'll notice that I say just South Dakota. I'll get into the reason why I say South Dakota and not the United States in a bit. So what it does is it adds economic nexus to a list of nexus creating activities. So it doesn't replace what is currently in place. So for example, having a physical presence, whether you have a remote employee in the state of Indiana, that would automatically create a nexus. Let's say you are going to a trade show in Las Vegas. That could also trigger an a nexus creating activity. Let's say you're using a drop shipper. That could also create a nexus creating activity. What this does though, is it adds another layer saying, hey, it's fine and all that you have all these nexus creating activities, but let's say you have economic presence within another state, you now have to pay that extra amount, even though you don't have that physical presence. It doesn't change what's tax exempt. So let's say you're selling food. Well, food is not taxable, so that won't change. But one thing that is a big difference now is that services are now taxed, because South Dakota taxes many services, and it's not just the personal property. And it also applies to manufacturers and wholesalers who sell directly to customers. So economic nexus, and why is that such a hot button, and why were the states pushing for it so much? Well, 47% of state revenue is based on sales tax. And the reason is because no one has ever gotten elected by saying, hey, we're gonna raise your property taxes, or hey, we're gonna raise your income taxes. The best way of collecting taxes without quote unquote too much blood on your hands is by just doing a sales tax. And 32 states right now are operating at a deficit. They have to make that money up somewhere. So economic nexus really is just a tax collection obligation imposed on the sellers based on their level of economic activity. So unlike physical presence, it's based either on revenue, transaction volume, or both. And I'll get into it in a little bit as to what I mean by that. But it's also very state by state. So I'll show you exactly what states are different and what those thresholds are. So let me give you an example. So the Supreme Court case came in June, the results came in June 2018. Well, as of July, 1 month later, you're looking at 19 states that automatically adopted that economic nexus. Fast forward 3 months, as of October 4th, 2018, you're looking at 29 states. Fast forward to January 2019, you're looking at 34 states. And now, as of last month, you're looking at 35 states, which you're looking at also April, California just came on. July 1st, Pennsylvania and Arkansas will come in, and October, Texas will join the realm of economic nexus. So if you look at the amount that is just adopted in just a very short period of time, less than a year, it's amazing what they're doing. And the reason why is because the internet has given such an unfair advantages to brick and mortar stores. But one thing you'll notice in orange that's really important is that 18 states in orange report it's not more than just taxable sales. Some also include exempt or non-taxable as well. So even if you're a nonprofit, or let's say you're a business to business and you're selling into these states, if you sell into those states, even though you're not collecting taxes, you still have to register with that state, which also means that you have to start managing a lot more exemption certificates. Something to keep in mind as well. So if you're looking right here, take for example, let's say Arkansas. Arkansas has something called a streamlined sales tax state. And what it does is it manages with 24 other states that could also help you in streamlining, so to speak, the filing and remittance of states. And I'll get into that in a little bit, how that can save you about 80% of what transactions charge. Then also you're looking at something like a click-through nexus. These states in orange right here, let's say you don't have a physical presence in these states. You don't even have an economic nexus to where you have enough transactions or sales to actually justify it. But let's say you have a banner ad, let's say in the state of Arkansas, you have a banner ad targeting people within that state. Well, if those residents click on your link and it reroutes them to your website, all of a sudden you do have a click-through nexus, in which case you do have to remit sales tax, regardless of whether you are having these thresholds also. So what can you do? First and foremost, call your SALT CPA. A SALT CPA is a specialist in the sales tax realm. Think of CPAs kind of like doctors or lawyers. Everyone has their own specialty. You're not going to go to a cardiologist if you have a problem with your knees, right? Or you're not going to go to a divorce attorney if you're trying to do tax law. Well, CPAs are the same way, right? So there's so many changes within the realm of taxes that you really need a specialist in terms of sales tax. So if you don't, and SALT just means a state and local tax CPA. There were 12,000 changes last year alone in the terms of sales tax. So keeping up with that can be confusing. And I'm going to show you an example of why that is confusing. And then if you don't have a SALT CPA, we also have a tax advisory service that can actually help you in terms of being able to calculate what your nexus is in terms of certain states. So one resource that you can reference that's free as well is Avalara.com, and it'll talk about the Wayfarer for South Dakota ruling and also up-to-date heat map of exactly what changes there are. And what I did is actually, I'm gonna go into it just to show you real quick what I mean. So here's the updated map, okay? And this is as of June 10th. You'll notice mine was May 29th, but there is no changes as of yet. But it'll give you the most up-to-date map. But one thing that's really great about here is as of June 7th, we actually monitor exactly what the changes are in each state. And this is updated on real time. So take, for example, let's say Georgia, you're doing business in Georgia. Well, in Georgia, if you have more than $250,000 in sales or 200 transactions, you have to file and remit taxes. But you'll notice in January 2020, it'll go from 250,000 to 100,000. But then let's take North Carolina. In North Carolina, it's more than $100,000 or 200 separate transactions. So for example, let's say you're selling widgets for $10 a pop. Well, you're selling into North Carolina, and if you sold 200 or more widgets, well, now you have to collect taxes in that state. And that's regardless of whether you hit that 100,000 threshold. So you'll notice that every state is different. So here, Tennessee is more than $500,000 and a systematic solution of sales in the state. Whereas you have most of them being at $100,000 or the 200 transaction threshold. So that's something to keep in mind, and it does change. California initially had their nexus, economic nexus trigger at 100,000, and they had to change it to 500,000. So just note it that these can change at any time. So what if you don't collect sales tax? And this is one thing I was going into, to where some states are monitoring economic nexus even if it is exempt. So because of that, we have a manufacturer in New York that before this Wayfarer decision, they had less than 75 that they had to manage. However, with their business, now that they have to manage 1,175 different exemption certificates. Or you have a national wholesaler, theirs is even worse. Before it was 500 and now it's 5,000 cases. So it's just really a matter of knowing how to manage this effectively, and doing this manually is a non-revenue generating activity. So automating sales tax compliance is a solution that we have. And why do we feel the need that you should automate your system? Well, sales tax doesn't make any sense. And I'm going to show you an example of just the most ridiculous laws in the United States regarding sales tax. So if you take a bagel in New York, well, it's considered a food, so it's exempt. But if you slice that bagel in half, all of a sudden it's taxable. Why? Because it's prepared food, and prepared food is taxable in the state of New York. Take, for example, a candy bar in the state of Indiana. Well, if you buy a Hershey bar, well, it's considered candy, so it's taxable. However, if you buy a cookies and cream Hershey bar, it's tax-free. What's the difference, you ask? The difference is wheat, flour that's inside the cookies and cream Hershey bar. Wheat is a subsidized item in the state of Indiana, and because of that, it is now tax-free. Donuts. If you buy 5 donuts or less in the state of Texas, it's taxable. But if you buy 6 donuts or more, it's tax-free. That's possibly the one that makes not a bit of sense whatsoever. But it's also not just limited to products. You're also looking at services. Snow removal in Ohio is taxable, while in Illinois it's exempt. Or tree trimming services in California. The labor is exempt, but if you use lights, it's taxable. So imagine being a controller or someone in the finance department trying to figure out what tax rates are effectively within your state, much less 50 states. It's a non-revenue generating activity, and it takes a lot of time to do. So let's say you're also going to be said, you know what, I'm going to calculate the rates on the products. Well, now you also have to calculate the rates based on certain cities. So take Denver, for example. Now, Denver has this little area called Greenwood Village. So Greenwood Village, you would think right here, 80111. I'm going to go with that. And I'm going to figure out the tax rates for that. You could even think to yourself, I'm going to do a zip plus 4. Well, I'm going to show you why that's incorrect. I don't care what kind of zip plus 4 you have. There's no way that this area and this area should match. This is in a completely different section. And it's because of redistricting or gerrymandering, depending on what side of the political fence you're on. Because of all this redistricting, now you're looking at different municipalities charging different rates, and they're drawing congressional lines differently. So because of that, now you have all these confusion on sales tax. So if you did a zip plus 4, you'd have to miss what, 2 counties, 3 cities, and a couple of district taxes that you wouldn't have otherwise known. And no auditor is going to let you go off with a warning saying, oh, you did your best. If you've ever been audited, you know that they will charge you and they will fine you. And if you are over a 30% variance within a state, each region, the Southeast, the Northeast, the Northwest, and the Southwest, will send notification to the partner states and say, hey, this person was over a 30% variance. You need to audit them. And this is by no means a scare tactic. Feel free to Google any of this information as well. This is just informing you what it is. The state of Texas also just hired 30 new auditors because of the Wayfarer versus South Dakota decision, because it's not just people within their state, it's also out of state that they have to collect sales tax in, and they do work with local municipalities to enforce those laws. So imagine filing a California state tax return. I have someone that works at Avalara. She has been a CPA for 30 years, and she tried her hand at doing a California state tax return. I'm going to show you exactly what that entails if you're planning on doing this alone yourself. And you might have to because of the new economic nexus laws and the Wayfarer decision. It took her over 2 hours to do this. So, and I'm just fast forwarding this, but one thing you'll notice right here is that everything is broken up into city level. Every city has different rates. So imagine doing this yourself. How long would it take you to calculate the rates for every city? Is that really the best use of your time? You know, this is a non-revenue generating activity. And what a controller can do, or—
Hi, George.
Yes.
Hey, you're sounding a little in and out right now. Just letting you know. But I don't know if you can be able to fix it, but
let me—
that sounds a little bit better.
It does? Okay, good, good. Okay, let me know if it falls off again, and we'll try to fix that then.
Sounds good.
Perfect. So this is a non-revenue generating activity. So imagine like what a controller or a VP of finance could do if they were, instead of doing this work, is trying to do a little bit more of a revenue generating activity, like streamlining your accounts payable department, or streamlining your accounts receivable department, or looking at the feasibility of bringing a new product to market within a certain demographic. That's really more of a revenue generating activity instead of this mundane type of work. And I'll tell you this, imagine 30 years ago, everyone had their payroll in-house. Well, now look at a company and tell me a company that has payroll in-house. Generally speaking, no one does that anymore. Why? Because it's a non-revenue generating activity and they can do something better. And I think it's safe to say that tax compliance is a little bit more complicated than just payroll. So Avalara really is the only end-to-end solution. I'll never bash our competition. I think that's in poor taste. But one thing I will say, we do have some competitive advantage that I'd like to highlight. That we are a tax company that does, we're a software company that does taxes, not a tax company that does software. And the reason why is because we pride ourselves on having a seamless integration with our competitors. We're also the only one that does returns in-house, to where we'll file and remit all of their returns. And we're the only ones that do guarantee our returns as well. And then we also manage 18 million exemption certificates. And we're the only company that keeps everything in-house. And with security being such an issue these days, knowing that you're keeping everything under one roof is really appealing to a lot of our clients. So we're accurate. We are efficient. We do provide real-time updates because we are a cloud-based solution. And we're also integrated. So we have over 600 integrations. So whether it's your ERP system, your e-billing, your e-commerce store, your CRM, we do have an integration for everything. One thing that I'd also like to bring up to you is we're one of the only companies, especially from our major competitors, that does streamline sales tax. Now, what this is, it's a service that is set up by 24 state and local governments to simplify sales tax compliance. So it helps reduce costs because it will give you free registrations. It'll give you free tax calculations. It'll give you free returns, preparation and filing, audit assistance and response, and then uniform decisions and rules. So obviously the other states that aren't part of the streamlined sales tax program, we could help you with as well. But this is just a government subsidized program that'll help you be a lot more cost effective when it comes to filing in these states. And the beauty of it is you don't have to register in every single state. You can pick and choose which one of the SST states you do want to focus on. So if you would like any more information on that, please let Acumen know and they will forward it to us, and then we'll be more than happy to have a sales rep reach out to you. And just as a barometer as to what is required to register in a state is if you've had a fixed business. So if you are required to be in that state, you can still register for SST. And that would also be a free service. But there's volunteering to be in a state and then non-volunteer status. And here are the thresholds, whether it's over $50,000 in terms of property in the state or payroll in the state, or whether you have 24% or less or payroll within a non-volunteer state as well. And again, if you do have any questions, our sales team would be more than happy to answer those specific questions that you may have. And here's some of our logos that we have as well. Obviously, we have something for everyone, so don't think that you have to be a huge company to do business with us. But the reason why I do this is just so you can see, how ingrained Avalara is in our society. I dare say that every single person on this call has used a client of Avalara at some point, whether you're wearing those Adidas sneakers, whether you've gone to Dick's Sporting Goods for your kids or yourself, using Salesforce for your CRM or Marketo for your email marketing automation, looking for Zillow to look for that house that you're looking for, or if nothing else, you've definitely used a Post-it note most likely. So that's pretty much I have. I'd like to thank you all for your time. Again, thank you, Acumen, for letting me speak to your clients. I'd be more than happy to take any questions at this time.